For 6 years straight, one company was named America's most innovative. It built a $70 billion empire on a revolutionary idea: trading the future. It booked massive profits on deals that hadn't happened yet and hid its colossal debts inside shell companies named after characters from Star Wars. And then, in just a few weeks, it all imploded. This is the story of Enron, how the smartest guys in the room built a house of cards and how it came crashing down, step by meticulous step. At its zenith, Enron felt less like a company and more like a law of nature. By August of 2000, its stock price soared past $90 a share, giving it a market value of nearly $70 billion. It was the seventh largest company in the United States. It wasn't just an energy company anymore. It was a sophisticated trading platform, an asset-light titan that promised to create markets for anything, from electricity and natural gas to internet bandwidth and weather derivatives. The message was clear. Enron didn't just play the game. It was inventing a new one. The accolades cemented the myth. Fortune magazine crowned Enron America's most innovative company 6 consecutive times, from 1996 all the way to 2001, the year it collapsed. This wasn't just praise, it was validation. To Wall Street, to its employees, and to the public, Enron's success seemed permanent. In the gleaming towers of Houston, the mood wasn't just confident, it was arrogant. Growth came from complex spreadsheets, risk was supposedly tamed by math, and the future belonged to them. But beneath the glossy surface, the cracks were already forming, and the first one was baked into the system back in 1992. That year, the SEC granted Enron permission to use mark-to-market accounting for its trading business. Now, this is a legitimate tool, but in Enron's hands, it became an instrument of deception. It meant Enron could sign a 20-year energy contract and immediately book all the projected future profits as current-day earnings. The cash might not arrive for 2 decades, but the profit landed on the books that very quarter. This created a ravenous hunger for new deals, any deals, to keep feeding the earnings machine. The projections themselves were a black box, based on secret, optimistic assumptions about future energy prices, interest rates, and counterparty risk. If reality ever fell short of these rosy forecasts, the gap between paper profits and actual cash flow would widen. On the quarterly reports, earnings looked impossibly smooth and predictable. In the real world, cash flow was lumpy and often negative. The model was consistently outrunning reality. This pressure was enforced by a brutal internal system known as the Performance Review Committee, or PRC. Unofficially, everyone called it rank and yank. Each year, employees were graded against each other, and the bottom 15 to 20% were fired. This fostered a cutthroat culture where appearances were everything. It incentivized traders to use the most aggressive accounting assumptions to close deals and book huge upfront profits, while pushing any potential losses far into the future. It was a race to the top, where the losers were simply shown the door. When the gaps between paper and reality grew too large to ignore, Enron needed somewhere to hide them. The architect of that shadow world was Chief Financial Officer Andrew Fastow. Starting in 1999, Fastow created a series of private partnerships, most famously LJM1 and LJM2. These entities were designed to do business with Enron. Their purpose was simple: to be a dumping ground. Enron would sell its underperforming assets or volatile investments to these partnerships, moving the risk and debt off its own pristine balance sheet and booking a profit in the process. There was just one problem. the CFO of a major public company running private funds that do business with that company, is a monumental conflict of interest. But Enron's board didn't just look the other way. They formally voted to waive the company's code of ethics to allow Fastow to proceed. It was an astonishing move that turned a clear conflict into official policy. For his efforts, Fastow personally skimmed more than $45 million from the LJM partnerships, all while supposedly serving Enron's shareholders. Fastow's partnerships were part of a vast, confusing network of what are known as special purpose entities, or SPEs. Enron eventually created hundreds of them, many based offshore in the Cayman Islands. The most notorious had cheeky names borrowed from Star Wars. In 1997, to hide debt from a venture called JEDI, Enron created another entity called Chewco. The joke was clever. The accounting was fraudulent. Chewco was supposed to be independent, but it was propped up with Enron guarantees, failing the legal tests for separation. For years, it allowed Enron to keep hundreds of millions in debt out of sight. The deceptions reached their most complex form in 2000, with a series of entities known as the Raptors. These were designed to hedge Enron's risky investments in tech stocks and other ventures. If the investments lost value, the Raptors were supposed to pay Enron, smoothing out its earnings. But this was a circular insurance scheme. The Raptors were capitalized almost entirely with Enron's own soaring stock. It was like buying fire insurance for your house from a company whose only asset was your house. As long as the house didn't burn, everything looked fine. The first public sign of deep trouble came on August 14, 2001. After just 6 months on the job, CEO Jeffrey Skilling abruptly resigned, citing personal reasons. Nobody on Wall Street believed it. The man who had personified Enron's aggressive strategy was suddenly gone. Founder Kenneth Lay stepped back into the CEO role, assuring everyone that the company was in great shape. But behind the scenes, a senior executive named Sharon Watkins had just sent Lay an anonymous memo warning that the company might implode in a wave of accounting scandals. The spell finally broke on October 16, 2001. Enron reported its third-quarter results. Instead of another smooth, predictable profit, the company announced a stunning $618 million loss. Even worse, it disclosed a $1.2 billion reduction in shareholder equity, cryptically linked to Fastow's partnerships. For the first time, the shadow balance sheet was bleeding into the real one. The black box had been cracked open, and the numbers inside were ugly. On the subsequent conference call, Wall Street's patience finally snapped. Analysts pressed for clear answers about the confusing finances. When one analyst, Richard Grubman, complained that Enron was the only company that couldn't produce a balance sheet along with its earnings, a frustrated Jeffrey Skilling, who had joined the call to add credibility, shot back with a now infamous line. "Well, thank you very much. We appreciate that, asshole." That moment of raw arrogance signaled to the world that Enron had something to hide, and it was done playing nice. The company's stonewalling only accelerated its demise. On October 31st, the SEC, now deeply suspicious, formalized its inquiry into Enron's accounting practices. The game was up. As the federal investigation began, panic erupted at Enron's auditor, Arthur Andersen. The firm that was supposed to be the independent watchdog began a frantic, systematic destruction of Enron-related documents, shredding tons of paper and deleting thousands of emails. The act would prove fatal. On November 8th, the past officially collapsed. Enron was forced to restate its earnings all the way back to 1997. In an instant, $591 million of previously reported profit simply vanished. Billions of dollars in hidden debt from entities like Chewco were finally brought onto the balance sheet. The beautiful, smooth earnings curve that had mesmerized Wall Street was revealed to be a complete fiction. The company's credibility was vaporized. With its cash reserves dwindling and its trading partners demanding collateral, Enron was in a death spiral. Just one day later, a lifeline appeared. A smaller Houston rival, Dynegy, announced it would buy the collapsing giant for roughly $9 billion. For a fleeting moment, it seemed Enron might be saved, its toxic assets absorbed into a stronger company. But the deal came with a condition: due diligence. Dynegy's accountants were about to get a look inside the black box. They didn't like what they found. The cash crunch was far worse than publicly known. Then, on November 28th, the rating agencies delivered the final blow. Moody's and Standard & Poor's downgraded Enron's debt to junk status. This triggered covenants in its loan agreements, demanding the immediate repayment of nearly $4 billion that Enron simply did not have. The same day, seeing the true state of the books, Dynegy walked away from the deal. The lifeline was cut. The end was swift. The stock, which had been over $90 a year earlier, was now trading for pennies. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. With $63.4 billion in assets, it was the largest corporate bankruptcy in American history at the time. The $70 billion titan of the new economy was worthless. The fiction of the balance sheet had finally slammed into the hard reality of cash. The fallout was devastating. More than 20,000 employees had worked for Enron. Over 4,000 were laid off almost immediately, packing their lives into cardboard boxes. Their retirement savings were obliterated. In 2001, 62% of their 401k assets were invested in Enron stock. Worse, the plan was frozen for an administrative change from late October through mid-November, trapping employees as the stock plunged from over $30 to under $1. They could only watch as their life savings vaporized. Meanwhile, top executives had already cashed out. Over the preceding years, Ken Lay had sold over $70 million in stock, and Jeffrey Skilling had sold over $66 million. The watchdog that was supposed to prevent all this, Arthur Andersen, one of the big five global accounting firms, effectively ceased to exist. It was convicted of obstruction of justice in 2002 for the document shredding. Although the conviction was later overturned by the Supreme Court on a technicality, its reputation was destroyed, and the firm collapsed, taking 85,000 jobs with it. So what is the lesson of Enron? It's a story about what happens when incentives write the narrative. If a company is allowed to claim tomorrow's hoped-for profits today and hide today's real losses in a maze of offshore shells, its financial statements stop being a record of fact. They become a work of fiction. A very compelling one for a while. Admiration, awards, and even auditors will follow the story, because the story is making everyone rich. But debt covenants and cash flow statements don't read fiction. They operate on the simple math of what you have versus what you owe. The Enron scandal was so profound it led directly to new laws, most notably the Sarbanes-Oxley Act of 2002, which reshaped corporate governance and accountability in America. It was a painful reminder that ambition needs friction. It needs independent oversight, skeptical questions, and a board willing to say no. Without that, a company isn't innovative. It's just a bubble waiting for gravity to show up. If modern business stories like this hook you, subscribe and see what else we've uncovered. We follow the rise, the spin, and the inevitable moment the cash runs out. Thanks for watching, and we'll see you in the next one.